let's start with derivatives. Derivatives broadly of two types: forward commitments and contingent claims. In forward commitments, forwards, futures, options. In contingent claims, we had CDS, credit default swaps. In forward commitments, what did I say? Forwards, futures and swaps. Okay, by mistake I think I said options. I said correctly, right? Forwards, futures and swaps in forward commitments, and in contingent claims, options and CDS, credit default swaps. Okay, fine. Now let's cover forwards and futures, mainly the difference between forwards and futures. Forwards have counterparty risk, futures have no counterparty risk. Forwards are traded over the counter, futures are exchange traded. Forwards are less liquid, futures are more liquid. Forwards are customized, futures are standardized. Forwards require no initial margin, futures require initial margin. Forwards have no concept of daily mark to market, futures have the concept of daily mark to market. Yes? Okay. Now in futures, which are the two types of margins? Initial margin and maintenance margin. Both the long and short party have to deposit initial margin. Then as the gain or loss may be on a day-to-day basis, that is when the margin adjustment is done. Okay. Once the balance goes below the maintenance margin, that party has to deposit additional cash to get the margin balance back to the initial margin level. Okay. Now also discussing about any type of derivatives, are they perpetual in nature or do they have an expiry date? All derivative contracts have an expiry date. Okay, remember that. So this was about forwards, futures. Now discussing about the pricing, what we'll do is we'll take one product at a time, completely discuss about that. Discussing about the pricing of forwards and futures. Spot price is what? The present current price. Okay. Forward price is the price as on the future date, on the date of contract expiry. Okay. So now how is the forward price determined? Forward price is equal to spot plus storage cost minus convenience yield. The whole thing compounded at the risk-free rate. Convenience yield is the non-monetary benefit of holding the asset. Remember that? Till now the benefit has not been accrued. So expected dividends, expected interest, all that is a non-monetary benefit of holding the asset. Okay. So costs will increase the forward price and benefits will reduce the forward price, of course compounded at the risk-free rate. Why do we compound it at the risk-free rate? Because arbitrage is a risk-free profit. Now you remember the concept of cash and carry arbitrage and reverse cash and carry arbitrage. Cash and carry arbitrage was what? Say for example, okay, so spot is 100, okay, and I'm considering a time period of 1 year. Risk-free rate is 10%. In absence of any storage cost, convenience yield, the no arbitrage forward price should be 110. But in case if it is 115, so what? It is overpriced. We have arbitrage opportunities. Yes, so sell forward. Whatever action you take in forward, the exact opposite action you have to take it in spot market. So you will have to buy in spot market. Now literally you will be carrying this commodity, assuming it's a commodity, for 1 year. Okay, so this is called cash and carry arbitrage. When forward is overpriced, that time you have an opportunity to execute a cash and carry arbitrage. When forward is underpriced, that time you have an opportunity to execute a reverse cash and carry arbitrage. Reverse cash and carry arbitrage mein what will happen is, say for example, the no arbitrage forward price should have been 110, but assume it is 107, underpriced. So in that case you will have to buy forward, and exact opposite position you will have to take it in the spot market. I am not explaining the entire procedure, we had discussed that. Okay, just to remind you that this was the case. Okay, so this was regarding the pricing. Once you decide the price of a contract, forward or future contract, can the price change once decided? No, once decided the price cannot change. What keeps on changing? Value is something that keeps on changing. Whatever is the value to long party before expiry, the exact is the value to short party. But if long party is having positive value, short party will have negative value of the exact same amount, because derivatives at the end is what? A zero sum game. Yes. Okay, we had calculated how to derive the value? You will have to discount and all. Okay, not solving any questions for now. Okay, if you want to exit the forward contract before maturity, what will you have to do? You will have to enter into an offsetting contract. Had explained the entire procedure. Okay, now the pricing of futures contract also is done in a similar manner as forward contract. Products, as you see, are the same, futures and forwards, just they have operational differences in terms of over the counter, counterparty risk and all those things, margin requirement, etc. But otherwise they are the same. Now one difference between forwards and futures is when I am having MTM gains and interest rates are high, can I withdraw the excess margin balance? Yes, and invest at high rates. That time a futures is more beneficial as compared to an otherwise equivalent forward. When I am having MTM loss and the interest rates are low, so no worries, I can borrow at low rates to fulfill my MTM call, margin call. So that is when we say that futures and interest rates have direct relation. If interest rates are high and MTM gain, futures are beneficial as compared to forwards. If interest rates are low and MTM loss, that is when again futures will be beneficial as compared to forwards. But if interest rates are high and you are having MTM loss, a forward would be more beneficial as compared to futures. Remember this, highly testable in my opinion. Okay, forwards, futures we understood, pricing we understood, price and value difference we understood. Okay, now going to options. Options is vast, many things we have to discuss in options. Which are the two types of options? Call and put option. In call option also there will be two parties, option buyer, option seller. Call option buyer, right but not the obligation to buy. Call option seller, obligation to sell. Put option, two parties again, option buyer, option seller. Put option buyer, right but not the obligation to sell. Put option seller, obligation to buy. Remember, option seller always will be under an obligation. Option buyer always will have the right but not the obligation, simply because the option buyer pays the option premium. Option seller is the receiver of the premium. Now when I talk about a call option, again it will have an expiry because it is ultimately a derivative contract. Now remember one thing, when it comes to call options regarding the profits and losses, option buyer has limited losses and unlimited profits. Limited losses only to the extent of premium paid. Option seller, call option seller has unlimited losses but limited profits. Limited profits only to the extent of premium received. Now when it comes to put option buyer, limited losses to the extent of premium paid. Naturally option buyer only will have limited losses to the extent of premium paid, and profits also will be limited. Why? Because theoretically price cannot fall below zero, right? So for a put option buyer, profit also will be limited, which will be predefined. Losses also will be limited to the extent of premium paid. And for put option seller, profits anyway are limited to the extent of premium received, and losses also will be limited, they will be predefined. Yes, so understand this. Okay, now when I discuss about the moneyness of options, first let's discuss about call. Three types: in the money, at the money, out of the money. In the money was what? Market price of the option exceeding the exercise price. Out of the money was market price less than exercise price, and at the money is when market price equals exercise price. Do you remember this? Okay. And for put option it was exactly opposite. For put option, in the money will be when market price is less than exercise price. Out of the money is when market price exceeds the exercise price, and at the money is when market price equals the exercise price for a put option, right? Okay. Now two types of options were there again when I discuss about it: American option and European option. Which option can be exercised anytime prior to maturity? American option. European option can only be exercised at maturity. Now remember, the difference lies in terms of exercising. When you want to trade the option, exit before expiry, that is possible in both European and American. The difference only lies in terms of exercising. Okay, fine. So European option will be relatively cheaper as compared to its American counterpart, because American counterpart gives the benefit of early exercise, so it will be priced slightly higher as compared to European option. Now when we think a bit about it, American call option as such is not beneficial as compared to European call option, because the price can keep on increasing. So if for example you had American call option and you exercised early and price went on increasing after that, you are benefiting. I could exercise as a European call option holder only on maturity, and that time also the price has skyrocketed. I also get to exercise at the same strike price. So how were you better off compared to me? No, you weren't better off. You will only be better off in one situation. American call option holder theoretically can be having benefits only when the stock is expected to pay dividends. So for example, if in 3 days the stock is expected to pay dividends, as an American call option holder, I can exercise it today and enjoy the dividends after 3 days, but the European option holder will have to wait until expiry to exercise, so he will not be able to rather enjoy the dividends, right? Okay. Then when we talk about put options, an American put option will be beneficial as compared to a European put option only when the option is deep in the money. Deep in the money means what? The market price has virtually touched zero. So as an American put option holder, I will exercise, and once the European put option holder goes to exercise, who knows, by then the market price may have risen, right? So I had an opportunity that time when it was deep in the money and I exercised my option. Getting it? Okay, fine. Now we had discussed what is exercise value of a call option. Exercise value is what? For a exercise value of an American call is maximum of 0, market price minus exercise price, exercise value of American call. Exercise value of European call is maximum of 0, market price minus exercise price discounted at the risk-free rate for the appropriate time period. We had discussed the reason why we do this apple to apple comparison, if you remember. Okay, now exercise value of American put will be maximum of 0, reverse exercise price minus market price, and similarly exercise value of European put would be reverse. Okay, I am not writing it again, but I hope you understand that. Now this brings me to a point: lower bound, upper bound. First let's discuss for American call. Lower bound is always maximum of 0, MP minus XP. Basically the exercise value is the lower bound, so at least the option premium has to be this much, and the upper bound is what? Market price. Now for European call, the lower bound would be the same, except for XP will be discounted at the risk-free rate, just one difference, and upper bound will remain the same market price. For American put, as we just discussed, maximum of 0, XP minus MP, and upper bound will be exercise price. And similarly for European put, same to same as above, just that XP discounted at the risk-free rate and upper bound remains the same. Okay, now if I ask you the breakup of option premium is broken down into what? Two parts: payoff, which is the exercise value as we just discussed, plus time value. Okay, when it comes to settlement of options, which are the two settlement types? Physical settlement and cash settlement. Cash settlement is also called as contracts for differences. Okay, operationally different, but end result we saw was the same. But practically speaking, the end result may not always be the same. Okay, but theoretically we understand that end result is the same. Okay, now this was about options. Most testable part, 6 factors affecting the option premium. First was strike price. Strike price and call option premium, what sort of relation? Inverse relation. Strike price with put option premium, direct relation, matlab opposite directional effect. Okay, strike price has opposite directional effect on both the call and put premiums. Now second factor was market price. I'll just write it down. First was strike price, opposite directional effect. Second, market price. Market price and call option premium, direct relation. Market price and put option premium, inverse relation. So again, it has opposite directional effect on both call and put. Third one was volatility. Volatility has direct relation with both call and put premiums. Volatility is the fluctuation, the kind of fluctuation involved in the markets. Higher the volatility, more would be the fluctuation. That is when call and put both would be valuable. So volatility has direct relation with both call and put premiums. Then fourth one was time to expiration. Time to expiration. More the time to expiration, more is the time value component. As the time to expiration comes closer, the time value component reduces. So again, it has direct relation with both call and put, and it has same directional effect. Same directional effect on both call and put. Then fifth factor was the rate of interest. Rate of interest has direct relation with call option premium, but it has inverse relation with put option premium. Now, if I have to just give you a hint, I'm not going into the depth of it which we had discussed in class. Call option, you have to think from the point of view of you getting an investment opportunity, higher the interest rate. And put option premium, you have to think in terms of what opportunity cost. Fine. So, conclusion is it has opposite directional effect. And finally, costs and benefit of holding the asset. Cost has direct relation with call option and inverse relation with put option. Benefit has direct relation with put option but inverse relation with call option. Cost you can consider storage cost for commodities. Benefit you can consider expected dividends. Yes? Okay. So these 6 factors affecting the option premium, very, very important. Okay. Now discussing about the binomial model. Remember spot price, up move factor, down move factor. Binomial model was used for what? Option pricing. Okay, then you will be getting a strike price. Say for example, strike price is 100 and we are pricing a call option. Where is it in the money? In the upper case. In case of an up move, it is in the money by 20. Market price is 120 and strike price for the call is 100. And here it is out of the money. Out of the money have zero payoff because they simply won't be exercised. At the money also zero payoff. In the money positive payoff. Okay. Also, before I forget, payoff and premium, are they the same or different? Payoff and profit, sorry, not payoff and premium. Payoff and profit, same or different? Different. During payoff, do you consider the premium paid? No. During profit, do you consider the premium paid? Yes. So payoff may be positive, and despite the payoff being positive, the profit can be negative. I mean, it can be a loss. Yes. Okay. But you have to exercise your option as long as your payoff is positive. Even if you may not get a profit, at least you are able to reduce the losses. Like that. That was the logic. Option seller is also called as dash option writer. And whenever they ask you profit or loss calculation, I had told you one thing specifically, that always solve the question from an option buyer's perspective. And if the question is asked from a seller's perspective, you solve as per buyer's perspective. Whatever is the buyer's gain would be the seller's loss. Whatever would be the buyer's loss would be the seller's gain. Okay, fine. Now binomial model this. Then you will have to calculate risk neutral probability of an up move. What was the risk neutral probability of an up move? 1 plus RF minus down move factor upon up move minus down move factor. Say for example 0.45 comes out to be the risk neutral probability of an up move, then what would be the risk neutral probability of down move? The balance 0.55. Then you have to do a weighted average of these payoffs. So 20 into 0.45 plus 0 into 0.55, but this is the payoff at the end of year 1. You want it today. So what will you do? You will discount it at the risk-free rate for the appropriate time period. That will give you the no arbitrage call premium. Then we went one step further to discuss that no arbitrage call premium is 7, for example, and market price of the call premium is 9. How call is overvalued? When call is overvalued, sell call. Now how did I teach you sell call and start thinking from perspective of risk? If you sell a call, what is the risk associated? The stock price going up, stock price going up. So to hedge your risk, what will you do? Buy stock. Now whenever you want to take a hedging position, please buy or short the stock. Don't do anything with options. Okay, so I bought stock. In what quantity? Who will tell me how many stocks to buy? Hedge ratio will tell me. Hedge ratio is C plus minus C minus upon S plus minus S minus. C plus is call payoff in case of up move. C minus is call payoff in case of down move. S plus stock price in case of up move. S minus stock price in case of down move. Okay, remember the entire process we had discussed along with numbers. In both the cases, up move and down move, we were getting the same
appointment of auditors.
Okay, so hedge ratio, the same formula for hedge ratio when it comes to put option, P plus minus P minus upon S plus minus S minus, right? Okay, fine. Now I'm not going into the calculation part of it. We had taken all 4 cases: call overvalued, call undervalued, put overvalued, put undervalued, right? Okay. Thereafter, tell me one thing. Do you really need the probability to calculate the no arbitrage call and put premium? No. Without probability also it can be calculated. Some algebraic calculation I had done. So we are better off without a probability as well. Okay, fine. So this was the binomial model. Then we had discussed put call parity in options. Put call parity was a combination of protective put and fiduciary call. Protective put and fiduciary call. Protective put is a combination of stock plus put option. Fiduciary call is a combination of call option plus a risk-free bond. Now just ensure the call option strike price, put option strike price and face value of the bond all are same. Otherwise this relation won't hold true. Okay. Now I want to replicate a long position in stock without buying the stock. Replication is what? Doing something without doing that particular thing, right? So I want to go long on a stock but without buying a stock. So how will I do it? Keep stock on one side, transfer everything else on the other side. So if I want to go long on a stock, what I will do? I will go long on a call, I will short a put and I will go long on a bond. But if they ask you such a question, if I want to go short on a stock, so then what to do? Minus sign, short, minus means shorting. Positive sign means going long. So here on the right hand side also I will minus. Now brackets open. If I want to go short on a stock by taking a replicating position, I will have to short a call, I will have to go long on a put and I will have to short a bond. You will get the same payoff as you would have gotten when you would have actually shorted a stock. We had taken numericals also and I had proved it that the payoffs are the same. This can be testable in MCQs, okay? They will give you 3 options. In one option, they will give you this one, the correct one. One option, they can give you short a call, short a put. Now that option is wrong because we go long on a put. So like that you can formulate anything. Okay, you don't need to remember as such. You need to know how to formulate it properly. Then there was put call forward parity. Put call forward parity was the same as put call parity, just that in place of stock it is substituted by forward price of the stock. Okay, we had done questions also surrounding this, so just be careful about it. So this was about put call parity. When typically put call parity is used when one of your options is thinly traded, so you want to find out the no arbitrage price of that, so you can use the put call parity. Or if you want to take replicating positions, that is when you can again use the put call parity. Okay, fine. So as regards options, do you have any doubts? This was broadly options at level 1. Is there anything that I'm missing out on? Please let me know. In absence of any info, please assume it to be a European option. Okay, fine. So this was it about options. Yes? Okay. Then discussing a little bit on CDS, you had only the basics of CDS. Credit default swaps is actually what an insurance product. You are a bond investor, you worry that the bond issuer could default, so you buy insurance. So you are called a CDS buyer. So, and there will be a counterparty called as CDS seller. CDS seller is also called protection seller. As a CDS buyer, you are called as protection buyer. Protection buyer pays periodic premiums to the protection seller, as in case of any insurance. The insurance buyer has to pay premium to the insurance seller. Yes? Okay. And in case if the bond issuer defaults, as a CDS buyer, do I have to worry? No, I don't have to worry, because the CDS seller will compensate me for the losses. And remember, CDS products are over the counter products, so counterparty risk could be there. I had taken the example of 2008 crisis, AIG. Okay, fine. Now at level 1 we have extremely basic stuff about CDS, that CDS buyer pays premium to CDS seller, and that's all. But there's much more to CDS which we will learn at level 2. There's a dedicated chapter to CDS, credit default swaps. Okay, but as of now for level 1 you just need to know this much. So this, why is it called a contingent claim? What is a contingent claim? The decision of which depends on something happening in the future. Okay, so CDS seller will compensate me for the losses only if there are if the bond issuer defaults in the future. Otherwise the CDS seller is not going to compensate. So whatever premium I have paid as a CDS buyer goes waste. Similarly, in case of normal options, as an option buyer, call option or put option, on expiry I can exercise only if it is in the money for me. Out of the money, why will I exercise? So my decision to exercise or not is highly contingent on future. That is why it is under contingent claim. Fine. Okay, now discussing about swaps, the basic interest rate swaps. Fixed for floating interest rate swap, two parties, me and the counterparty. I pay fixed and receive floating. So from my point of view, we call it pay fixed swap. The counterparty's point of view, you call it receive fixed swap. When will you enter into a pay fixed swap? When you expect interest rates to increase. So you pay fixed and you hope to receive floating at a higher rate. And as regards receive fixed swap, you will enter into a receive fixed swap when you expect interest rates to fall. So you receive fixed at a higher rate and pay floating hopefully at a lower rate. We had also discussed one product called as FRA, forward rate agreement. Now the difference between swaps and FRAs, there were two differences. FRA, just one payment is exchanged and the contract is settled. But in swaps, is only one payment exchange or multiple payments are exchanged? Multiple payments are exchanged. Moreover, the second difference is FRAs are settled in advance, swaps are settled in arrears. Now what do you mean by advance settlement? Say for example, I enter into a 3x9 FRA. 3 months from today I want to borrow for the next 6 months. So as a borrower, the fear is that interest rates might increase. I want to lock in a particular interest rate. So I lock in an interest rate of 5%. No matter what, I will borrow at 5%. And at the end of third month, I get to know that actual interest rates for the next 6 months have gone to 7%. So is it a benefit for me? Yes, because I have locked in a lower rate. So the counterparty will compensate me for the gains. I have enjoyed gains, so I will get that from the counterparty. Now this 2% of gains into the notional amount into 6 by 12. Why 6 by 12? Because it was for 6 months. Now whatever the winning amount, I will tell the counterparty that I don't want to wait till the end of 9 months. Please settle it in advance at the end of 3rd month only. That is why we say that FRAs are advance settle. Now when you have to discount this amount, you will discount at the 5% locked in rate or the prevailing rate. The prevailing rate will have to be used for the discounting purposes, adjusted for appropriate time period. 6 by 12 because we'll be discounting it by 6 months. Okay? Yes. 2%, 2 divided by 100, you can do it like this. That's the difference. 2% is the difference between my locked in rate of 5% and prevailing rate of 7%. Okay? The borrower in a FRA is called the long party. He is long a FRA. And the counterparty is called short the FRA. Long FRA party benefits when interest rates go above the fixed rate. Short party to FRA benefits when interest rates go below the fixed rate. Yes? Okay, fine. So this was about FRAs. We had solved multiple questions in class, numericals and all, if you remember. Now discussing about swaps, I have entered into a 1-year swap with a counterparty with quarterly settlement. So 4 such payments will be exchanged between us. The first payment will be exchanged at the end of 3rd month. Say for a swap, I am the pay fixed party. So I will pay fixed. Say for example 5% is the fixed rate. So throughout from my end I will have to pay 5% fixed. The floating which I will receive at the end of 3rd month, that rate I will know at time 0 only. At time 0 only I will know what floating the counterparty will pay at the end of 3rd month. So whatever floating, this is known at time 0. Now at the end of 3rd month I will know the rate for the next 3 months, floating rate. So that will be received. See, it is decided at the end of 3rd month but will be received at the end of 6th month. So whatever floating I receive here, that is already known at time period 3 months. So decided in advance but settled in arrears. Since it is settled in arrears at the end of time period, there will be no concept of discounting. In FRAS, since it was advance settled, there was the concept of discounting. I hope you understand that. Okay. Then we had also understood one thing, that if 5% is the fixed rate which I have to pay, the floating rate happens to be say 4%. So what will happen? I will net pay 1% to the counterparty. Always remember, net payments are exchanged on the notional amount. Okay. Swap also will have a fixed expiry. Yes. Okay. And what is the price of the swap? What is referred to as the price of the swap? Say for example in options, the price of the options was the option premium. In case of forward, the forward rate, the forward price was the price of the forward contract. So what do you call the price in a swap contract? What is referred to as the price? The fixed rate of the swap contract is called the price of the contract. The fixed rate. And I had taught you the pricing of fixed rate, how fixed rate is calculated in a swap contract. There, it was complex algebra that we had done. We had equated the legs using the concept of spot and forwards. That concept had come into picture when you decide the fixed rate. Also the concept of spot and forward comes in when you want to decide the fixed rate of the FRA, the locked in rate. I had given you one very simple method to solve spot and forward questions rather than following the formula method, timeline method, if you remember. That concept is extremely critical. Please understand that, okay? So swap fixed rate, that entire big method, of course I am not discussing because it will take a lot of time. The shortcut method which I had given you to find out the swap fixed rate, if you remember, swap fixed rate, SFR is swap fixed rate 1 minus final discounting factor upon summation of all discounting factors. Now how to calculate discounting factors, that we already know. That's a basic thing. So if the 1 year spot rate, 1 year spot is 8%, so discounting factor will be 1 divided by 1.08 to the power 1. Remember that? Okay. You should know the relation between spot and forward rates also. Very important. If I give you spot rates, can you find out forward rates from that? Yes. If I give you forward rates, will you be able to find out spot? Yes. The process of finding one rate from set of other rates is called what? Bootstrapping. Okay. Follow my method which I had taught you. It is very easy and you will never go wrong rather than following the formula method given in the textbook. Okay. Fine. Now this was about swaps. Is a notional exchanged in swap? No, notional is never exchanged. It is just used to calculate the interest. Also net payments are exchanged, that we already discussed. Now just like any derivative contract, the concept of price and value will be applicable in case of swap contract also. Price of the swap contract, that is the fixed rate, once decided does not change. It remains constant. Price once decided cannot change. What keeps on changing? Value of the swap contract. Sometimes the pay fixed party may have positive value. And when will pay fixed party have positive value? When the floating rate goes above the fixed rate. So I pay a fixed rate of say 5%, and if floating rate is say 7%, I receive floating at 7%. So net 2% I receive. So that is when it is having positive value for me. Sometimes it can have negative value also. That's pretty much possible. Okay, fine. You don't have valuation of swap concept at level 1. Valuation of swap as a concept is covered at level 2. Right now at level 1 you only have pricing of the swap. Okay, fine. So if I want to convert my floating rate liability into a fixed rate liability and all, for that we had understood we have swap contracts. Okay, fine. Now FRAs and swaps we understood. Let's discuss interest rate futures. Interest rate futures. If you remember IRF interest rate futures, this was the convention, 100 minus the interest rate. Say for example, current interest rate is 4%. So price of interest rate futures is 96. This is the standard convention. I believe interest rates would fall. That is my view. So interest rates would fall to 2% is my view. So then the price of the interest rate futures contract will become 98. So what should I do? Should I go long on interest rate futures or short? I should go long. Always see the price and comment. 96 was the price. If you go long, you can buy at 96, sell at 98. Always comment on the basis of price. So I would go long. Here it seems counterintuitive that when interest rates are going down, you are going long. But you see the pricing convention, no? It is special in this case. So accordingly you comment. Okay. Also, I'll tell you one thing. Please understand it very carefully. The concept of long party enjoying when things go up. I keep telling you, long party enjoy when things go up. That is only applicable in all cases except for interest rate futures and options. Options may it is not applicable, and interest rate futures may it is not applicable. Options are a different category altogether. So they are long party. Can be long party to the call, long party to the put. Long party to the call benefit when things go up. Long party to the put will benefit when things go down. So I cannot generalize and say that long party always benefits when things goes up. No. I hope you understand that. Okay, fine. So this was about your swaps. Can a floating for fixed swap be possible? Yes, pay fixed, receive floating, pay fixed, whatever. Fixed for floating swap is pretty much possible. Is a floating for floating swap possible? Yes, it is possible. Also called as basis swap, BASIS, basis swap. Both the benchmarks would be different. If one is LIBOR is no longer there, but as an example I take LIBOR, the other could be some other benchmark. Is a fixed for fixed swap possible? Absolutely no. Fixed for fixed swap is not possible. Knowing that I have to give you 5% fixed and I will receive 7% fixed from you, I will always net rate receive from you. So what's the point of having a fixed for fixed swap? So that's why it is not possible, right? Okay. Now when I discuss valuation of any derivative contract, be it swap, option or anything, value at initiation has to be how much? 0 for both the parties. Otherwise none of the parties, one party would be incentivized to enter into the contract, the other party won't be incentivized to enter into the. So in order to incentivize both the parties, valuation at initiation has to be 0. So that is how the pricing has to be done, such that it has 0 value at initiation. Subsequently, it is the nature of derivative contracts that one party will have positive value and one party is going to have negative value. That is unavoidable. But at initiation, we have to ensure both parties have 0 value. Clear? Okay, fine. Now discussing about linearity and convexity of payoffs. That concept also we had discussed. I had drafted a question also on that. Forwards, futures, what kind of payoff? Linear or convex? Linear. Options and CDS, convex payoff. Remember, contingent claims will always have convex payoffs. Swaps, interest rate swaps, again linear payoffs. Interest rate futures, linear payoffs. But when it comes to FRA, forward rate agreement, convex payoffs. The convexity in forward rate agreements was coming because of the discounting factor. I had shown you the entire calculation. In case if you have forgotten, please watch the recorded video to recall. Okay, it's extremely important. Fine. Anything else that I'm missing out on? Theory part I have to discuss, but apart from that, by the way, just for your info, swap fixed rate is also called as par swap rate. So in case if you are asked par swap rate, don't get confused. They are asking you swap fixed rate only, right? Okay. Now let us discuss that situation where I have a stock. I am concerned about the downside. I have the fear of the stock price falling, but at the same time I want to enjoy the upside. Which derivative position works the best for me in such cases? No. Stock I already have. Why do I need to buy stock? I want to protect my existing stock position. Buy put. Buy put. I cannot short forward. Forward becomes an obligation. Remember that. So if I buy a put and if the stock price goes down, I don't have to worry because put is my insurance. And if the stock price goes up, I again don't have to worry. At max, I will lose my premium, but I am at least able to enjoy the upside. So you should be able to identify. Okay. Now if I tell you that I want to get rid of the stock, and I am not concerned about the upside, I want to get rid of it. Between short forward and short call, what should I prefer? Very important. Between short forward and short call, what should I prefer if I want certainty? Short forward. Because if I short a call, it highly depends on long party to the call and the price at expiry. Whereas a short forward, there will be certainty that I have to deliver at that particular price, right? But if I have no hurry, I don't want any sort of certainty, what works the best for me in order to get rid of the stock? Short call. I had discussed the reason why. Because you receive premium income. So keep doing that. First month you may not be successful, but at least you pocketed the premium income. We had taken 3-4 cases like that. Okay. And that is one strategy also. Okay, fine. So this is what you wanted me to discuss, right? Okay. Anything else that you want to know? Just remember that concept of BPV, basis point value. Basis point value as a concept is useful when you want to calculate the gain or loss on interest rate futures. So basis point value essentially means what? For 1 basis point movement in interest rates, how much is the gain or loss? So for example, I have gone long on interest rate futures. Means what is my view? My view is that interest rates would fall. Basis point value is, say for example, 6,000. So this is 6,000 will be the gain if interest rates go down by 1 basis points. As long party, I want the rates to go down. If rates go down by 1 basis point, 6,000 is the gain. So what if rates go down by 30 basis points? I will have a gain of 1,80,000. We had done also one such question. So in case if you are tested in MCQs, you should be in a position to answer this. Okay, fine. But if the interest rate goes up by 30 basis points, you will face a loss of 1,80,000. Okay, fine. And linearity in interest rate futures, it won't be convex, it will be linear in nature because it is settled in arrears, not in advance. In terms of interest rate derivatives, only FRA was one which was settled in advance. That is why convexity was coming into the picture. Fine? Okay. Now when I discuss the theory, the advantages of derivatives, disadvantages of derivatives, advantages were what? You can hedge your positions, you can speculate based on your views and stuff. The exporter importer, they benefit because they have currency forwards and also multiple such benefits. Disadvantages, people have started to gamble. Implicit leverage is one risk. Implicit leverage means what? Futures is a leverage position. You just pay the initial margin. Balance money is sort of, you are getting funded for it. If things go up, you will benefit significantly, but if things go down, you will lose also significantly. We know the concept of leverage. We had done it in quants, right? Okay. So leverage position, derivatives of leverage positions, that's why the risk is also more. Also, what is basis risk? Risk of mismatch. The farmer example, if I had given in class, you remember? Farmer example, wants, the harvest is ready, but the counterparty is not ready to take delivery on that date. The counterparty is ready to take delivery on other date, future date. So that is what a basis risk, mismatch. I want to hedge my position, but I don't have, there are no futures and options available on the stocks that I have. So I use nifty futures and options to hedge my position. This again becomes what? Basis risk. I'm using nifty futures to hedge my portfolio. And my portfolio pe there are no futures and options. Derivatives, as you know, are not available on every stock, right? Okay, fine. Also, I just remembered one thing, options. When it comes to options, if they ask you to calculate the break-even price and all, break-even price, no profit, no loss, will you be in a position to? You should be in a position to. Okay, no profit, no loss. We had practiced such questions in class. Okay, fine. That payoff diagram and all that, you don't need to remember it. I mean, if you conceptually understand, that would be enough. Anyway, you don't have to present the payoff diagram and all in the exam. Okay. Is there anything else? Cash flow hedge and fair value hedge. Now, I had taken a sufficient time to explain these concepts. Cash flow hedge is when I want to protect the certainty of cash flows. Say I'm an exporter. I will be receiving dollars 1 month down the line. I don't know at that 1 month down the line what will be the exchange value of dollar. So I enter into a forward contract with a bank. That is called cash flow hedge. I have protected my cash flow because I now know with certainty for every $1 that I exchange, how many Indian rupees I'm going to receive in return. So that is cash flow hedge. Fair value hedge was a detailed concept. I want to, change my position from fixed to floating and all that. That I had given you notes. So just refer to those notes. Now if I sit to discuss, it will take a lot of time for fair value hedge, but it is important nonetheless. Okay, fine. Is that all in derivatives? Currency derivative is also covered here. I mean the currency forwards. Forward is equal to spot into 1 plus interest rate of price currency upon 1 plus interest rate base, that we have already discussed in eco. And whenever currency forward, there is a mismatch, how to execute the carry trade in that also we have discussed. Okay, fine.